Good morning, MMTs. Here is a new added program document called Trade Management. This program document here is going to be mandatory participation to gauge index corrections. When the bull is having a correction, then you're going to learn how to gauge it by looking at both sides of the market. The one that we're going to really focus on are going to be relative to the S&P. We like looking at the SSO and the SDS. One of the reasons is that the volume on them work quite well. And the ranges on them, like here on the SSO, this is the bull. This range here is $1.44. Okay? Range select sort ascending. No, I can't do that. Today's range descending. There we go. So what we have here is in the SSO, which is down here, it's $1.44, and that's the true range. That's, you know, $1.44 up or $1.44 down, and that's the bull. The opposite one over here is the SDS, and its range is only 53 cents. So it's narrow range on the bear for now. You can see the correct differences right here. So here's the range on the bull, which is greater, and the SDS, which is less. But they're related. Doesn't matter what the dollar price range is. What matters is how to use it intraday by looking at it and reviewing it. So if you're trading a listed stock in the S&P 500, why is that stock going to sell off at the intraday high peak and never look back? Is because I can tell you why. If you know that the bear is bouncing off that strong support level, then the bull side of the rally is in a correction. So the bull side rally is now in a correction for 10 days. That's how you want to monitor the S&P. You really want to just keep them in your level 2, and you can go long this bull off of the bottom as well, but you can short the top of that. You can short the top of that. So that's that setup there. So if we're in a bull correction, I can short this. This is where the correction started. We said there was going to be a correction, and we had the 1, the 2, the 3, the 4 days. There's the 5th day. You come down, you bounce 2 days, and you roll over. You make the lower lows in the volatility trade. When we are on these daily moving averages, if the 10-day moving average is rolling over on a daily level, and we are going to sell through the 20-day simple moving average, there is more downside here, and this bull is still in a correction. You can see where the correction started, and it's on the home page. We said the indexes. This is tied to the S&P, period. And you can clearly see where the high was, where we were up here, and that's also on the S&P 500 index. Now, these are ETFs, bear and bulls. So the SDS, it's a volatility trend. You're going to have increased volatility for the summer, but you're making lower lows in the trend. If the S&P 500 bull is making and the bear is making their moves, one is going to be building a pattern. This one over here has built and showed me a pattern. It broke out the 4 days when we broke down these days here. Not only that, when we had the 2-day rally in the original reversal, we came down 2 days, but then we're building a base off of here on the daily, and quite the opposite in the daily moving averages are in play. Here, let's blow this up. This one here, you've got a 10-day simple moving average, and these are public indicators. Your platform is going to be what guides you through, but this is what the public looks at. So you're building on top of these, and if we break out, where's the bigger breakout going to happen, and where's the bigger breakdown? So I've got strength being built to the upside here with the daily moving averages. And over here, I've got bear moves being set up with declining. And where would be the next sell through, and where is going to be the next buy through? The buy through breakout will happen here. The lower that we go below the 20-day simple moving average, we would see increased selling here and increased buying here. We will be using it as a barometer related to the S&P 500. There will be other instruments as long as we're in the bull rally correction with increased summer volatility, price volatility. We told people 3 weeks ago that we were going to have intraday price volatility for the rest of the calendar year, in the calendar summer. And we're going to be able to gauge the volatility with both instruments. This one's building a base to go higher in the bear, and the bull over here, on the other hand, MMTs, is weakening. And when you're going to put on an intraday trade 1 out of 5 days, you say you got 5 trading days, and maybe it's 2 or 3 out of it, maybe it's only 1 big day, it doesn't matter. It's when the breakout, why would the breakout happen here and you'd be long, and why are you going to be short over here? Because you're short over here and you're going to get a big sell and you're going to get a breakout. So when this short is going to be supported with people's stop market orders getting taken all the way out. 100-day, 50-day moving average is right above 53. Okay. On the other hand, the upside here is the same 50-day moving average. The white line is going to be this potential resistance. If we blow through there, then that means that this one over here on the bull is going to sell down, and we would break higher through there. MMTs.